simple, autopsy, if you will, on this firm. So why? At least the major points. A, the change in law in 2018 that weakened Dodd-Frank, which required that banks with assets over 100 billion were regulated a lot more stricter. They actually have to have an office for the regulators and controllers in residence. If you were below that threshold, you were only examined by your regulator every 3 months, and there was nobody in residence following the day-to-day business. And depending upon the kind of bank you are, you could be regulated by FDIC. If you're a bank national bank holding company, you're regulated by Fed. And if you're a so-called a national bank, you're regulated by, what was the name? Office of Currency Controller, okay, OCC. And the so-called credit unions, they have also a separate regulator. I think NCUA, something like that. There was a reason for that threshold. Was the fear of contagion. So if a large bank went down, for example, by the way, this is the second largest bank failure in the history of the United States, even including adjusting for inflation. Before that, Washington Mutual went down in 2008. That was the largest. And a few days after this, a bank called Signature Bank, it went down. They also had over $100 billion asset, and that was the third largest bank failure in the United States. You could kind of see where this was going. Okay, a lot of corporate banks, a lot of corporations hold their deposits in banks, mid-sized to large. If Fed actually didn't back up all the deposits, there was going to be a bank run on all sorts of banks with assets from 50 to 100 billion. Smaller banks tend not to have that much big deposits because anything below 250 is already guaranteed anyway. So individuals, at least most of them, wouldn't be harmed. But there would have been corporations. Even if those banks could survive the run on the deposits, the resulting credit crunch is going to kill small and mid-sized business, period. It's not just the banks failing. I mean, let's let the banks fail. There's no problem there, okay? And let's even allow those corporations that were stupid enough to have deposits more than $250,000 in a small to mid-sized bank. I mean, put your money in Chase, JP Morgan, or I don't know, put them in 3-month T-bills. They're not as liquid. If you need the money, you can get it tomorrow. A bank deposit, you can get the money right now. That's kind of the difference. But the resulting credit crunch is going to is going to create a deep recession. Probably not as deep as, not probably, definitely not as deep as 2008, but I would not have been surprised if the growth rate went below negative 3% as a result of such a credit crunch. Sure, there is a moral hazard. This basically signals to the banks that in the future, if they take the risk, or the corporations in this case, if they take the risk and deposit their money to a bank that pays them higher than, let's say, 3-month US T-bill, they're going to be saved. Okay? On the one hand, we don't like that, but on the second hand, the damage that's going to be created is far larger. Okay? These are always problems where you have a credibility issue of that limit. I mean, there's other than 1930s, where institutions like FDIC and deposit insurance came about because of those bank failures. I don't remember a big bank failure where large depositors were not saved. What are you going to do? You're the regulator. I mean, how are you going to basically think about what if I don't save, and people will realize that they're not going to be saved in the future, but in the meantime, you're going to create a very deep recession that may last quite a bit of a time. The decision is not that difficult. Okay, you have to save them, and you do. But that limit in Dodd-Frank, where the banks were considered significantly large, where if they fail, it could create a contagion effect. They're regulated very, very tightly. Okay, and I don't know this for a fact, but I think even their liquid instruments are measured as mark to market. The trouble with Silicon Valley Bank was in 2018, that limit was increased to 250 billion. I mean, I don't particularly care what your political inclinations are, but this bank did not die because of wokeness. Okay, it died because, I mean, who knows whether or not it would have failed if a stricter regulation was there, but at least we know for sure that it was going to be a lot less likely. The issues could have been caught long before. SVB realized losses of about 1.8 billion out of sale of about 22 billion in T-bonds. You're probably thinking, how can you lose that much money in T-bonds? Well, that depends on the length of the maturity. It sounds like, and I don't have the details on the maturity of SVB's assets. I can probably find out from the people who's done this consulting deal, because it is no longer private information. I'm sure Accenture would have no issue divulge that information. Since I was an outside consultant, and my role was limited to consulting on statistical and economic issues. So we talked more about the effect of a deep recession on different things. they didn't need me to calculate what would happen to their long bond portfolios if the interest rates went up. That's an easy calculation. But let's assume that they had a 20-year average maturity on their bonds. Remember, we talked about duration and average effective maturity and financial duration. Let me see. What I'm going to do right now is more speculation, but it's kind of an educated speculation. Sometimes that's all you can do. I think we covered it here. No? It was before that. Oh, value and duration. Okay. I'm going to assume that they were par. Let's think about only the last 6 months. Okay. Let's look at the 20-year bond rates. 6 months.